Today on the Altimetry Authority show, a couple of banks have gone under. That's caused people to have big concerns about commercial lending. That's pulled down a whole bunch of banks' stock prices.
We're going to take a deeper dive today on whether that's the case or whether it's a buying opportunity for regional banks. And we have found two regional banks we think are interesting potential buys now. Today on Altimetry Authority.
Let's talk earnings and favorite pastimes.
So let me just say, earnings
Wall Street
It's
why do they
2.5x.
Because their compensation goes up.
Wall Street's wrong again. So last month, there was one thing that really everybody thought might finally be the sign that would upset this market. And that was when we started to see a couple of cracks seem to show up in lending, in bank lending. First thing that broke was obviously First Brands. First Brands came out and they collapsed. And a lot of different people on Wall Street and regional banks all had to take some hits. Everybody, this is a wild story for those of you who weren't following it, that effectively the company had posted collateral for multiple different loans, and then just $2 billion went up in air. Now, what we found out after the fact was that was because the CEO may have been playing a little fast and loose with some of the money. Everybody, right, Joel, needs a few Porsches now and then. But right, this was the first sign that everybody said, oh, something's happening. And then literally right afterwards, you saw a subprime auto lender, effectively Tricolor collapse, and Fifth Third and a couple others had to take some hits. And then literally right after that, you then saw something on the West Coast, right? The first two of those were both related to autos. So everybody could say, oh, you know what, it makes sense. Autos are under pressure. So, hey, but there's a little spook there. And then on the West Coast, we had a real estate developer basically go belly up because of the fact that they weren't able to pay their loans. And when they did, everybody found out that both Zion and Western Alliance, two big construction finance firms, both were holding the same collateral and having some issues. So everybody said, oh no, this is the sign that not the consumer is finally under pressure, but credit is finally actually going to be an issue. And everybody, Joel, you and I thought that this was important to talk about because, Joel, what do we say is the most important thing that powers the economy up and down?
Credit, of course. Corporate credit, right, as well as consumer credit.
Right, and so, hey, everybody, we were also the ones who'd say, hey, look, let's check in and make sure that we don't need to have a reason to have worries about this. And so, of course, the thing is, first off, let's be real. If you talk about the areas that blew up, the areas that blew up were the exact areas that we have been talking about for like a year and a half, or actually 2 or 3 years, Joel, when we talk about real estate, have been issues for a while, right? Real estate, in terms of commercial real estate, if you're not building data centers, really, it's not even warehouses in data centers now. If it's not building data centers, I don't know anywhere in commercial real estate that you want to be everybody right now. And two, in terms of the consumer, well, look, auto delinquencies, right, are rising. Student loan delinquencies, credit card delinquencies, we know that this is an area under pressure. So no wonder when you stack that with Trump's tariffs, that some of these auto companies and auto dealerships were going to have an issue. But the real issue and the real reason you have to ask a question is, okay, Russ, we had a blow up, we had 2 blow ups. Is this a signal for contagion? First, can the banks handle these blow-ups? Are they in a position based on their balance sheets where they can handle it? And two, is this impacting banks' willingness to lend? Because everybody, if you want to understand whether or not that's going to cause a collapse in the market, in a bear market, those are the 2 questions you need to ask. Can bank balance sheets handle it? And are banks and other lenders changing how they're lending based on this? And so the first thing is, look, we can look at a million different ratios to say, are banks healthy or not? But pretty much all of them look like this ratio does here. This is just a real simple ratio of bank equity to assets. And the way you can think about it is the way that banks make money is banks assets are their liabilities. It's a really weird business, which is why you can't look at them the way you look at any other company. Right? They turn their assets into cash flows by literally lending money off of them. And so what you always want to think about is for your assets, what percentage of your assets are backed by equity? Meaning that you have a threshold if your assets fall in value that you aren't belly up because you can't pay your depositors and anyone else who you've borrowed money from. And when we look at banks, right, bank balance sheets in terms of equity as a percent of assets, which got to kind of low levels in 2023, which is part of what caused Silicon Valley Bank and all the other banks to blow up, that did blow up, the 3 or 4 that did. it's actually rebuilt at a pretty healthy way. So we're not in a place where banks are really under stress in terms of their equity to asset ratio, or if you look at capital to asset ratio or any other metric, there's nothing that flashes a warning sign for banks. They've done a good job of rebuilding balance sheets, so we're not seeing risk in terms of bank balance sheets. And the second thing is, if we look at this in another way, now let's ask the question of, are banks changing their willingness to lend? And not just banks. Again, let's talk about all lenders, because banks are not all lending nowadays, right? You've got banks are like a $2 or $3 trillion lending market. You got private credit, which is now, I think, north of $2 trillion. Joel, I think that sounds right? Roughly, give or take. And then you've also got the public markets, right? And so when you look at a broad-based metrics of all of that, that's what this metric tracks. And this is from the Federal Reserve Bank of Chicago. What this is the National Financial Conditions Index, the NFCI, and it's a metric they've tracked for basically at this point 50 years. The way to think about this, it's like when we talk about the SLOOS, the Senior Loan Officer Opinion Survey, where if this line is above 0, that red line, that means that financial conditions are getting tighter, right? You can see the times that you see financial conditions getting tighter during the Great Recession, during the massive interest rate hikes that we saw in the late 1970s and early 1980s as Volcker tried to kill inflation, and all those things. Right now, we are still seeing banks ease availability of credit and all other forms of credit creation, easing availability of credit. This, to me, and to us, Joel, looks like a very healthy market in terms of lenders making it easier for people to borrow, not harder. And if we don't see this reverse, everybody, you won't see us in a recession and in a credit collapse that causes the market. I don't know, Joel, if you want to add any more context to that.
And just the context is just in sheer number of banks. So yes, a couple of banks have gone under, and people are then pointing to Silicon Valley Bank, which was some time ago already, and Signature and others. But we're not talking. I mean, we're talking about maybe 10 banks. Right? In 1991, I mean, what caused a recession, 1,000 banks went under. 1,000. That's the order of magnitude that happens, because it's not like the U.S. only has 20 banks. The U.S. has something like 8,000 banks. So the fact that a couple of lenders, one of them case screwed up, the other one probably overdone in subprime autos, anything that's commercial lending related, we'd say keep watching for the other shoe to drop, because commercial lending to offices, office commercial, is still in inning 4 or 5 of a Great Depression of office lending, as people are still on a giant work from elsewhere, anywhere but the office, work from home, work from a beach, work from wherever, right? And that's going to continue. We don't see any change in that. There's a handful of companies that said bring people back to the office, but it's nowhere near the amount that aren't in the office or going back to the office. So when you look at that, yes, I would expect to see maybe a couple more bank surprises that are in subprime autos or still office lending related. But that's still only the banks, which is only a portion of total corporate credit. Private credit from the big firms, the big private equity firms, traditionally KKR, have been increasing the amount they've been lending. That's been on a tear, actually. Then that's making up for where you see a little bit of softness from the traditional bank lenders. And then, of course, you get the public debt markets, which right now in the United States are incredibly healthy.
Wide open.
Incredibly healthy. There's an incredible appetite for corporate debt by investors. And so when you put that together, a few headlines does not make a contagion. We're nowhere near a contagion. And for this reason, we're still very, very bullish on the economy and the stock market as a whole, minus a couple of bad pockets.
Yeah, and I mean, everybody, for context, right, this is, when you look at this too, these are situations where these banks aren't even under pressure because of it. Didn't go in. I mean, Zion's immediately bounced back because everybody realized that it was an overreaction. Fifth Third immediately bounced back. And the reason why was because of the fact that everybody realized, oh no, these are not things that are going to pull banks under or cause banks to change their lending strategies. Not at all. And so what we did is we said, hey, because of the fact that people were a little spooked about banks, though, let's poke around at some banks that actually don't have exposure to the most worrying parts of the markets, that could actually be interesting banks that the market may be misunderstanding based on all of this news. And we found two that we want to highlight in particular. The first is Huntington Bank Shares. And so Huntington Bank Shares, just really quickly, as always, These orange bars are the orange distorted as reported return on equity that you would see for these banks if you just basically pulled it off of Bloomberg or Yahoo or anything else. And you can see for Huntington Bank shares, you've got a company that has around a 10% return on equity. When we look at it on a uniform accounting basis, though, and we restate the financial statements and see what real profitability is for this bank, this is a phenomenally healthy, very profitable, high return on equity bank with return on equity that's north of, for most of the last few years, 15% and 12% now. Just for context, the cost of capital, the required rate of return for a bank is around 9%. So it's actually looking pretty healthy here. But here's the thing. Wall Street, right, because possibly for the news that we're talking about here, is spooked that this bank is going to have lower return on equity going forward, and the market, which is what these white-blue bars are, with the white bars, not white-blue bars, I love that, white bars are right at a $24 billion value market cap for Huntington Bank shares. These white bars are what the market's pricing in. And what's really interesting for us is, so Huntington has smaller consumer exposure than most of the rest of the world and has smaller CRE exposure than most of the rest of the regional bank world does. It's much more C&I lending. And so we look at this and we go, hey, for the market to basically be expecting that this company that's been a pretty good operator is going to see ROE fall off a cliff, when we're saying we're not seeing a bank crisis here, this bank is very healthy and not exposed to those markets, and as we talked about recently, we're likely to see a lot of interest rate cuts that make their financial situation look a lot healthier. Huntington looks really, really interesting to us. The second bank we want to highlight is Third Coast Bankshare. This company is a company it's a bank primarily based in Houston and in Texas. And so, right, Texas, a great market to be in right now in terms of what they're doing. Now, they, right, actually have seen a pretty good recovery. They had some struggles in 21 and 22, as you can see from their ROE dipping those years. But now in 2024, they're back to 12% ROE. And Wall Street, when we take Wall Street analyst estimates and we push them through uniform accounting, all their estimates all the way down from revenue to interest income to everything else that you look at for a bank, Wall Street's forecasting return on equity to stay pretty robust at these 12% levels. And yet, here we've got the market pricing ROE at a $500 million market cap for the firm for the ROE to basically drop down to 7 to 8% levels. When you think about it, okay, if Texas looks like it's going to be a next area, following PJM, where we're going to have a lot of data center build, oil and gas markets are starting to get more healthy in terms of investment for demand. Houston is still a booming market. You think about San Antonio and Dallas too, and you think about West Texas, where Third Coast also has exposure. The idea that they're going to be under pressure when basically every single part of the Texas economy is looking pretty healthy for them, everybody, that just doesn't make sense, especially because, again, they do not have a lot of CRE and consumer exposure. So these are two that we think, because the market's overreacting to this news, are really interesting companies to look at right now that you should keep your eyes on.
They don't have a lot of CRE, meaning they don't have a lot of loans to commercial real estate, the areas that we're worried about. And since they don't have that exposure, why is the market pulling this down? Maybe because they're a little small. They're under $1 billion in market cap. I think that's where we find some of the coolest, most interesting names, because they are a bit overlooked by both the buy side and the sell side sometimes. So for those reasons, this is looking really interesting and quite inexpensive.
Yeah, right. And to your point, Joel, in terms of size too, companies that are this size are those bite-sized morsels that, people who are looking to consolidate, and there's a lot of consolidation looking like it's going to start to go on for banks, might be picked off. Well, everybody,
right.
If you want us to look at some other banks, like we looked at Huntington and we looked at Third Coast, drop them into the comments below. And if you enjoyed this, hit the like and subscribe button and come back for next time. And that's this episode of Altimetry Authority. Thanks, everybody.